Hey Team AAA, it's Melissa Ashcroft here, the owner of the AAA Financial Group and host of the P.O.W.E.R podcast, Property, Ownership, Wealth and Everything Related, where we talk about everything property, money and power moves. Each week we sit down with industry leaders to unpack their career journeys, their perspectives on the market and how they've built success in a constantly changing landscape. Today I'm joined by Matt Wallace, Commercial Director of Valuations at Ray White Commercial, one of the most respected professionals in Australia's valuation and advisory space. With decades of experience accessing the true worth of assets across Sydney and beyond, Matt offers a unique lens on the market, where the market's heading, what's driving value, and how investors can make smarter decisions. Matt, welcome.
Thanks for having me today.
Thank you so much for coming.
Finally got there.
We made it. We did make it. I've been championing to have Matt on for most of this year, so it's good that we've made it in the second half. And now we've got
the last quarter.
The last quarter.
We're on the home stretch.
Oh, we're nearly there. Almost, but look, it's never ending, as we both know.
It isn't.
And you've been in this industry for quite some time.
Absolutely.
And so a lot of our listeners not only want to find, and watchers, viewers, want to find out more about valuations and property valuation, but I don't think people really know much about commercial valuations, but also how to become a commercial valuer.
Yeah, sure.
So tell me about your career today.
Look, I started off as a residential valuer. I did that for a couple of years till I got my CPV.
And what's a CPV?
Certified Practicing Valuer. So you need 2 years of full-time experience doing valuations or assisting in valuations. So you can get your unrestricted license. So CPV means you can value commercial, industrial, development sites, going concern, but you need a lot of training in all those various specialisations. So I moved into commercial values 2 to 3 years after I started and sort of haven't looked back.
Good. And what is it about commercial values? So I assume a lot of people are just a standard valuer, but this is like an extra level of difficulty or degree of difficulty?
Yeah, look, I look at commercial, industrial, retail assets, and what I like about it is each asset's different. So you sort of, every property you look at throws something different at you. It could be demolition break clauses, under market rents. You've really got to put your thinking cap hat on for every valuation you do, and it keeps it interesting because it can be quite mundane at times. Yeah,
I understand that. And basically, most of our listeners know that we've been doing commercial mortgages and loans since the late 80s. So we've seen, quite a big diversity and quite a big landscape of what's happened in the market. But let's just talk a little bit more about you and before. So did you go to uni? Were you always a valuer?
Look, I didn't know what I wanted to do after school, and
most of us.
We didn't, and a few of my friends' older brothers were doing the property economics degree at UTS, which was called land economics at the time. So my mum enrolled me in that.
Thanks, Mum.
Thanks, Mumsy. And which was a 4-year course. It may have taken me 4.5 years, but I finished that. And at the same time, 2 years into uni, I was doing assistant val work for an old val firm called Stanley Thompson Valuers.
Yes, right.
In North Sydney. So
it's always been the trajectory.
Yeah.
And now you're the boss of all the bosses.
No, not really, but I try. So I'm at Ray White Vals now. We've established there 6.5, 7 years ago. When we came out of Landmark White after they had a large data breach. And it's probably been the best move for all of us. We went over as 14 people and we're now 55 and in 3 states. So and so your job, not only do you do the valuations, but you also lead a team. Look after New South Wales. So our 3 teams there: commercial, res dev and going concern. So it keeps me busy.
I think I know most of your team.
You do. And look, when you said you've been doing mortgages since the 80s, a lot of my colleagues were doing them with your dad, the valuations back then. When we were at Landmark White.
It's been, I think just being in this industry, as we both have for a couple of decades now, it's interesting just to see where things are. And, you touched on under market rent. And so I might just segue to that quickly, if that's all right, because it used to be that a commercial investment or commercial property investment was a sound investment. You had a 5-year lease or a 10-year lease. The tenants would pay on a CPI increase. Offices, we did a lot of offices because we're Sydney based. And then how has that changed, and what do you think are the main reasons that that's changed?
Well, look, I'll probably use the example of industrial property. In the last 5 years, there was a massive undersupply.
Yeah.
And rents were sitting around the $150 a square metre rate all throughout Sydney, or particularly western suburbs.
Yeah.
They doubled in the space of 2 to 3 years because of just the lack of supply.
Yeah.
And industrial land's very constrained in Sydney.
Yeah.
There's not really any being released till the airport comes out, and that gets serviced, so you're looking 3 to 4 years there. So it's a supply and demand factor. So when you're looking at a valuation with an under market rent, you're looking at the reversions that can occur. So you're assuming an investor is going to look at it and say, in 2 years I'm going to get vacant possession, or I get a market review. What's the market review going to be then? And then you're looking at the present value of the rental shortfall till you get those reversions at the lease expiry.
Yeah. That's very well put, because I don't think everyone really understands it's supply and demand.
Yep.
And then, so if we just go back to COVID and working from home and offices, because a lot of our listeners, they might be interested in commercial property, they might be looking at doing something like that, but they have no idea how it's valued. So would you say Sydney City has a lot of supply and not much demand?
Yeah, you got a lot of supply. Well, look, there is demand in the market at the moment, and it's the flight to quality. So what you've seen is businesses trying to bring their employees back to work on a more consistent basis. Instead of being in the B or C grade building in the Western Corridor, they're taking smaller space of a better quality in a better building in the city centre and the financial district. So they're quite prepared to pay a bit more in face rent, but knowing they're going to probably get a new fit out included and a 30% incentive. So their net effective rent is probably the same as what they're paying at the old place, but they're getting a much better building, a lot more ESG, and a better quality of life for their employees when they do come to the office. Yeah,
exactly. I get that. Because I think a lot of people are like, oh, well, no one's touching commercial at the moment, but actually when the owner or the landlord is in a position where they can offer a rent abatement or can offer, a fit out to get people back in, and businesses get all the nice looking fit outs, they get the, colour scheme that matches their branding and things like that. It isn't such a big not such a big oversupply, sorry.
Yeah,
I
correct.
Get my
correct.
economics confused.
And then and we're looking, what you see is the B and C grade buildings that have really high vacancy rates. Those buildings are going to be repositioned to either residential or hotels or whatnot. So it's just the cycle of the market we're in at the moment.
That's right. And speaking of the cycle of the market, how do you think interest rates and tightening lending conditions have influenced valuations?
Well, look, good question. I'm going to answer it in two parts. I think lending conditions and the tightening of them, they've really loosened in the last couple of months.
Yeah.
You're seeing ICRs down quite low compared to quite large highs off the back of COVID.
Yep.
And you're seeing a few rate cuts as well. So I think, look, we've never been busier.
Yeah.
And
I know.
Yeah. Hopefully we're keeping you busy. But I think definitely, and banks have a large appetite to get market share, which they've lost to private credit over the last 5 years as well. So you're seeing
a comeback.
They're making a comeback. A lot of it is refinancing. A few transactions are starting to creep into the market. And I think investor demand is starting to pick up. There's a lot of people with a lot of equity and unused funds out there that they need to disperse.
Yeah, I agree. And so people understand how a bank will look at a commercial property as an investment. Yeah, good time to have a drink. Is that they will go, how does the income cover the repayments by X amount? So they'll say, does the income of the rental cover the mortgage repayments by 1.2 times, by 1.5 times, by 1.65 times used to be what the banks were positioning it at. So what that meant was you could only really borrow like 50% of the value of the property based on the lease income. But as they bring down the income ratio compared to the interest repayments, it means that it's closer to that one, if the better positioned banks and non-banks at the moment are closer to that one number, which means you can service maybe 65, maybe even 70% of the loan, because you really, on a $3 million office, to purchase it either in your self-managed super fund or as a company or as a personal investor, putting in 1.5 million is losing a lot of your natural liquidity.
Yeah.
You'd probably prefer to put in, 750 if that's what you had, and then have the rest covered by the actual rental.
Yeah, that's right.
Over time.
With the ICRs coming down, have you seen the banks willing to go higher with the LVRs as well?
A little bit, yeah. Like CBA this week have just come out with a lease stock product.
Yep.
But they're like, oh, it's so great. No, CBA. But they're like, it's so great. We'll go to 65%, but it's 1.5 times. I'm like, well.
Really, that's 60% LVR.
Whereas others like St George, if up to 3 mil, they're 1.1 or 1.2 times cover. So it doesn't really matter what the lending is. You can just borrow as much as you can. And, we're talking about I guess if I was just to speak, $1 million, if the rent's 40 grand a year, and if you've got a $1 million loan, you're paying maybe 36,000 a year, then you're in front. Yeah. That's what you want it to be, but not such a big differential, because if there is between the repayments and the rental, who has to pay it but the borrower?
That's right, yeah.
Yeah, so I think that's just where brokers do, the general market, unless you've been doing this a while and been around, it's like, what? How does that work?
And I think your ICR is one thing, but as well, if you've got a lease expiry coming up in 6 to 12 months and you haven't started the lease renegotiation discussions, then you could find yourself in a bit of trouble 18 months down the track if they vacate and you haven't filled the tenancy.
Exactly. And the banks, so everyone knows, they do an annual review. Some even do biannual. So every year you have to show, where the lease is up to, where your financials are, etc. But the non-banks will just do a set and forget type loan. So if you've forgotten to, or your tenant leaves and there's a space, but you can cover the difference, then they're not going to know about it.
Yep.
So saying that, it's probably good to be on top of it, as you said.
Lower interest rate.
Much lower interest rate,
more governance versus higher interest rate, more flexibility. So
yeah. And so you know where it is now, you know where it's been. Where do you see things going in the next 18 to 24 months? God. I bet you get asked this a lot.
I do. I never get it right. So, particularly
none of us have a crystal
particularly
ball.
with the housing market.
We've got crystal glassware, just not a ball.
Yeah. We got some vodka in there?
Yes, this is vodka.
18 months. Look, I don't know. I'll start with this year. I don't think we'll probably have another rate cut before Christmas. Mm-hmm. So where that leaves the resi market, I don't know. We're coming into heavy spring conditions now, so you'll see a lot more stock coming onto the market, which there already is. Mm-hmm. In terms of the commercial market, look, incentives they had peaked at sort of 35-40% in the city, depending if you'd taken a fit out or not. Yep. I know they're sort of down to 30 to 28% now.
Okay.
Primarily,
think it's going down?
Well, no, primarily because that A grade, premium grade stock, a lot of it has been filled.
Yeah.
So, it's interesting. Maybe the institutional office market possibly has bottomed out. Maybe another 25, 50 basis points to go, depending on who you talk to.
Yeah, I don't know.
No. I don't think anyone does.
No.
There's not a lot of transactions to benchmark either. So
yeah, that's true.
It's when you're not seeing sales transact, you really are sort of using. I don't want to say using the crystal ball. You're hypothesising a lot of things.
Big word.
So and look, the industrial market's still pretty strong. Rents have peaked, come off a little bit. Incentives are starting to creep up.
Yeah.
Cap rates are pretty consistently sub 5%.
Yeah.
And in a pretty tight range as well.
Yeah. I've not done more industrial in the past year than I have ever. Yep. And I'm seeing more and more of it. I think people realise it's not only good and easier to develop, but also in certain pockets there are, increased areas, demand. Yeah. And then also rezoning, like, we have one in the inner west where, there's a whole belt being rezoned.
That's right.
And so, I think it's about having a long-term view potentially and seeing what, yes, you can use some rental income to abate things, but choose areas where there is significant growth planned or at least gazetted by councils.
And that's northwest Sydney in my eyes, like Rouse Hill, Annan Grove, etc. So a lot of that area's been rezoned, B6, E4. You're seeing a lot more strata industrial developments, bulky goods showrooms in those areas. So.
Yeah. So if anyone needs, they should just check our show notes and you can just, give them a chat, walk them through in your spare time.
Possibly. Let's see.
So what is one of the bigger, I guess what we'd say is a misconception in the market about valuations? Like, let's say there's an owner who has an assumption at one point and you're in another. Where are they going wrong?
Look, I think some owners, when they're getting their property valued, can get misconceive what the basis of valuation is, whether it's an as-is in-use investment valuation or a highest and best use valuation. Obviously, from a lending perspective, they're two different things.
Yes.
Highest and best use is a much lower LVR versus a higher LVR for investment valuations and lending. So, like it comes down to yield.
What is yield, just in case people don't know?
It's a market yield, a capitalisation rate that you're applying to the assessed net market income versus the passing. So the passing income could be below market, and we put market rents on what is actually market and look at the reversions there of rental shortfall or profit rent, letting out periods, future incentives and whatnot. So, if someone's not happy with a val, sometimes they're like, but it's got development potential. Yeah, but you've got a WALE of 5 years and no demolition clauses. So it may have latent development potential by virtue of being underdeveloped, but you can't do anything with it for 5 years. So you've got to sort of take a balanced approach there of what cap rate to adopt based on the evidence and the market.
So it's more that I think what you've just explained then, and I don't think most of our listeners would fully understand all those terminologies, nor do they need to.
Yeah.
But it's more about, it's not just, okay, we've got this lease, we're in this good area. You combine a whole range of sources to determine what you see it to be. And it's based on facts within the market. So you're not just pulling I think it's this out of what I think it is. You're actually using...
Yeah, well, I mean, you're looking at things like lease covenants. How good's the tenant?
Yes.
Are they just a local one-man band or are they a national tenant like a bank?
Yeah.
So you've
got
you've got a lot more income.
You want to be long-term tenant.
Yeah, they're not going to they're not going to default. Banks may not renew these days. They move to a smaller footprint, but generally like a Telstra or someone as a tenant, that they're good. They're going to spend a lot of money on the fit out. They're probably going to take up their options. So those are the things you look at with what drives that return parameter.
Yes.
Also your WALE, how long is your lease expiry?
So WALE is your weighted average lease expiry, which basically means if you've got 3 years left or 5 years left, it's not like a whale from the ocean.
Yeah,
it's
correct.
It's just another acronym from our industry,
Silent
of which
and
there are many.
H, But
P.O.W.E.R.
it's all those things like how good is the income stream?
And how long is it coming for?
That's
Are they renewing? And
that's right. And look, on the flip side, a lot of underdeveloped sites, investment properties, people are in there and below market rents with demolition clauses. So often you can get vacant possession to do your development within 12 months. So you sort of approach it on a lower yield basis then, because it does have that development upside, and an investor probably isn't going to buy it on a market yield.
Yeah. And so just as like a general question, and what percentage of valuations that you see in New South Wales, so not just you, but like your whole team, are owner-occupied versus investment?
Good question. A lot of the industrial stuff is owner-occupied.
Yep.
Traditionally, it was cheaper to buy rather than rent.
Yep.
And more so now with the way rents are.
Yeah.
So generally, industrial, you're sort of looking at 70% probably is owner-occupied, particularly strata industrial. The buyer pool for that is generally tradies, small offices and small industrial,
space
150, 250 square metres.
Yeah.
It's not an occupier market there.
Yeah.
Retail and office is more traditionally investment, grade vals that we do on that stuff. So, that's probably high, higher at 70%,
at the other
investment
way.
basis.
Yeah, true. And for self-managed super funds, we do touch on this a lot. And so I am a strong advocate for, if you're currently a tradie or you're currently working in an industrial space paying rent, wouldn't it be more ideal to, maybe you've been doing that for 10, 15 years, the owner doesn't want to go through the process of selling because you've got a very unique fit out to what you do. Potentially you can liaise with that person to purchase it for your self-managed super fund, and then how it works is the business is separate entity, pays rent and pays that down.
Yep.
Are you seeing?
Yeah, we see a lot of that, and I as people have moved away from managed super to self-managed super funds, you are seeing a lot of people do that, and pay off those assets quicker and
for sure. And your business is paying it off, and you're not paying interest. You use your rent to pay interest.
That's right. And I know our valuations for super have really increased over the last 3 to 5 years. Because agents can't give appraisals anymore on it.
Oh, really?
Yeah, so we do a lot of desktop super vals on that basis.
Okay.
So.
Okay, that's interesting. Okay, the next thing is just going to go back to you. So I know you love talking about yourself, but what's the best career advice you've ever received?
You're only as good as your last valuation.
Okay. Is that like a true thing?
Yeah, I think, look, every value you do goes out there, it goes to a broker, it gets shopped around, and so, another value see it. So
we speak about valuers with trying reputations, and, there's definitely a lot of market sentiment.
Yeah, and
especially with me and my industry, like I kind of ear on the ground,
So I think you're only as good as your last vow.
I guess it's sage
thanks,
advice.
Mike Covey and Robert Wilson.
I don't want to be only as good as my last loan. But maybe
Maybe you are.
Maybe
What was your last deal?
Maybe I should change it today.
Yeah, good. Winning.
Well, that's the plan. And have you had what's the most memorable or quirky or weirdest thing? Like, have you ever had to
in a vow?
Just what? Or just
here's
security.
A good one for you.
Yeah.
About 20 years ago, I was valuing a site at P.O.W.E.R. It was 5 houses in a row.
Yeah.
The managing agent had arranged access for all 5 properties, or at least I thought he had.
Yeah.
One of the houses had the windows boarded up. And so the agent started kicking it in and trying to get in. I said, look, I'm not comfortable. Can we arrange another time? He goes, yeah, sure. Look, come out Friday, 4 o'clock. So here I am out the front of the property, 4 o'clock on a Friday.
Yeah.
About 50 cops came with guns drawn as I was sitting in the front of my car talking. I put my hands up and I said, I've got to go. And they said, who are you? What are you doing? And I said, I'm a valuer. They're like, we're rating this house as there was a hydroponic set up in the house. So
they would have got a good value.
Yeah, they interviewed me. I showed them the emails and whatnot.
Yeah.
And then I said, can I go? And they're like, yeah. And I said, well, can you just tell me if it's got 2 bedrooms, 2 bathrooms like the other 4 houses? Or can I just grab a photo? And they said, no, it's a crime scene. You're going to have to come back. So,
But you asked. I think that's the most important thing.
I did, I did my DD. But that was a great story that afternoon at the Bondi Hotel at 5 p.m. when I got there with my mates.
Your hands up. It wasn't me.
It wasn't me. I didn't do it. I'm just a humble valuer.
But is it 2 bed, 2 bath?
Yeah. So that was
it's the hydroponics from the ceiling that increased that
added
valuation.
Value.
Yeah, added value. And what's so you mentioned the Norwest being one of your preferred. Is that your favourite area to go? Or?
No, look, I just know there's a lot happening out there at the moment in terms of my favourite area to go. I don't really care.
Yeah.
Like, each area is different.
Yeah, each valuation you do is very unique, right?
Yeah, that's right.
Unlike resi, you can kind of bank them up and be like, oh, well, that's that. And
you've got your 20 site sales you use and you pick the right ones. So
the level of complexity.
That's right.
I've got some more difficult ones.
Have you?
Yeah, of course.
Let's chat about them after.
Mine are never easy,
no, they're not.
sure.
No.
And then just as a final question, what is a power quote or mantra that you live by? And it can't be you're only as good as your last valuation. That's
exactly what I was going to say. I live and breathe it every day. Let's go back to the original question you had. What's my coffee order?
Yeah, what's your coffee order?
In the morning, it's a large oat cap, and after lunch, it's a double espresso with 1 sugar.
Martini.
No, double espresso
martini.
No, well, that's on a Friday.
Today's
Friday. What time is it?
Well, thank you so much.
No, thanks for having me.
Very informative. I think if anyone out there needs to understand valuations in more detail, it's about doing your research, but that you really have to liaise with an expert. So for in debt, that's coming to someone like myself who's specialised in commercial broking for some time, and I have strong relationships with the best valuers around. But not only that, it's about talking to them, understanding their level of professionalism, how strong their reputation is in the market, and which banks that they can go to and non-banks, and that's a very important part of this process. So thank you again, Matt.
No worries.
Really
Thanks
appreciate
for your
time. And ciao for now.
We'll do it again.
We will.
Thank you.